watching Stockwatch. I'm Zinati Kuma, and joining me to unpack your stock-related questions today are Jean Pierre Verster from Protea Capital Management and Grant Nader from Benguela Global Fund Managers. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or an X at Business Day TV using the hashtag Stockwatch. Thank you so much for your time, gents. Let's get straight into the questions. Pretty interesting one that has come through. With SA experiencing low growth and low growth forecasts, why do you think the JSE, excluding resources, is rising? Of course, you know how volatile the resources are. Just now they were leading the gains, now they're leading the losses. But just, I guess, yeah, excluding those resources, Grant, let me start off with you. Why is the JSE performing well amid an environment that, that is very, very anemic growth?
True. I think there's probably a few reasons. We're excluding resources, which are one of the reasons. But if you think about it from an SA company perspective, you've got a strong rand, you've got a weak oil price, you've got low inflation, you've got real wage growth as a consequence, you've got interest rate cuts at the margin. And so you've got an economic outlook that is, yes, it's pedestrian, but it's better than it was. And often in the market, it's all about, are we moving forward or are we moving backward? Are things getting better or worse? So the prospects for growth are slightly better than they were. So a number of these cheap SA companies are benefiting from that. And I think there's a little bit of looking ahead at better prospects. There's still value on the JSE. And then, of course, we've got a lot of large cap global industrials that are not resources that earn their money outside of SA. Naspers process being one of the most obvious, really carrying the index to a large extent, the biggest stock by far in the index as a combination. So that's a big contributor. The likes of Bidcorp, Richmond, BTI, Anheuser, a lot of stocks have performed. So it's been an incredibly broad-based move, which is why it's a really healthy bull market, the way I look at it.
Yeah, it's quite interesting because, I take your point, Grant, in the fact that the JSE has a lot of big companies that have exposure overseas. But just specifically drilling into SA Inc. Has SA Inc. then, JP, been responding to this better, improving environment that Grant talks about with lower inflation and lower interest rates?
On a 12-month basis, yes. A lot of SA Inc. shares are up sharply on a 12-month basis. But if you look at the last couple of months, a lot of SA Inc. shares have not done too well. If you look at the retailers, for instance, we had a lot of retail shares reporting results, and those companies reported okay results, and the share prices are trending slightly lower, most of them, to where the share price were just before the results were announced. So it all depends on your time frame, your measurement period. And as we know, stock markets in the short term do all kinds of unanticipated things. Share prices move in ways that we after the fact try to give reasons for, but basically in the short term it's quite random. And that's why I would rather focus on the long term, and that's where you can see this improvement that Grant referred to when you look at SA Inc. shares on a rolling 12-month basis. What's going to happen in the next 12 months? I have no idea. The World Bank today said our forecasted GDP growth is going to be significantly lower than they thought previously. So that doesn't look great. But they are coming from very low levels in terms of the share prices of these companies. So again, it's about changing expectations. And even though we still expect low growth, if the growth is slightly higher than the previous expectation, you would expect share prices to rise. So in general, SA Inc. shares are still on the cheaper end of the spectrum, not as cheap as they were a year ago, and therefore they seem reasonably well placed looking at their performance, which might be the case in the next 12 months or longer.
I guess another question is really the fundamentals of the companies versus the share prices. Sometimes the discrepancies that you'll see with that, and that specifically relates to a question that came in for Boxer. Is this all hype and no show? Do you believe in Boxer? Seems all hype and no show since listing. It's stuck at 64 Rand. We know how great the company is doing, but the share is stuck. Grant?
I think investing requires a little bit of patience. I wouldn't say it's done nothing. I mean, it went all the way up to 70 or more, and it's now come back. And again, what's your timeline? So I think if you're looking 2 to 3 years out, Boxer will be a very good story. You will see growth. There's a clear path that they have laid out, and I think they will execute on that. So if you want to trade it, it doesn't look particularly exciting, but for an investor, I think it still looks attractive at these levels. You just need a little bit of patience and just to extend your timeline. As JP said earlier, the short-term market price movements, they go up, they go down for no particular reason, but longer term, the fundamentals will drive it.
Yeah, it's really not looking exciting right now. I mean, compared to what the price was in March. JP, Boxer, what are your thoughts on it?
Very similar to Grant's. So as you correctly said, Zenati, the operating performance of the company is very strong. And in time, the share price performance will track the operating performance. So just because it hasn't done so the last 3 or 4 months doesn't mean it's not going to do so the next 3 or 4 years. So if you believe in the operating performance and that the profit growth will be strong, then I think you can put Boxer in your investment portfolio, not necessarily in your trading portfolio.
Okay.
But then again, at least Grant and I are investors rather than traders, and it's the preferred way to make money in a boring way over the long term versus the racy way to think you can trade in the short term and make money that way. You can't. Sorry to give the little secret away, but you can't. So you can make money with investing. You can't make money with trading.
I mean, it's also good that at Business Day TV we cover all sides of the spectrum, the investors and also the traders that also rely a lot on the technical.
Trading is for entertainment, Zenati.
I'm finished. All right, let's get into financial services. Old Mutual over the next 12 months. Yeah, Old Mutual is also one of those where people feel like it hasn't done much. It's, I guess, maybe less exciting than its peers in that insurance space. But I don't know. I've been seeing a lot of interest on it recently. Grant, your take on Old Mutual, particularly for the next 12 months?
I've been in the SA market a long time, and this one has overpromised and underdelivered for many, many years. But having said that, I think of Momentum as an excellent case reference. So Momentum also struggled and was a value trap for many years. But when you get the right CEO, the right leadership in, with a strong franchise and a strong base like Old Mutual actually has, and they start to execute on some of these plans well, which they haven't quite been doing. But if they get that right, there's a lot of value to be unlocked. I'd like to see some of that before I dive in, but I can't deny there's potential. It just needs execution at this stage.
Yeah, I mean, people were, the investors, based on the share price movements, people seemed optimistic that there's a change of the guard there. But also, I mean, entering a new, a new landscape with banking. Yeah, JP, your thoughts on Old Mutual? I mean, over the next 12 months, they will have the bank, so their model is going to look slightly different. Your take on Old Mutual?
Yes, it's going to be very interesting. So the new CEO, dynamic CEO, entrepreneur, hopefully can breathe some life into Old Mutual, like the changing of the guard happened with Jeanette Marais coming in at Momentum, and Risto Katola as CFO. So it's going to be interesting. He sort of inherited the strategy of investing in this bank. So it's going to be interesting if he also is going to agree with the strategy and how much more money is going to be invested in the bank, and what the synergy is going to be between the banking operations and the insurance operations. Because we know banking is very competitive in South Africa. You've got Capitec, the leader. You have a few challengers like Time Bank. So, wow, to have Old Mutual Bank in there as well, which will probably be at, call it the more value for money end of banking versus the likes of Discovery Bank, which is more affluent banking. It's a crowded field. So let's wait and see. Because of this, my preference is still for the better performing life insurance companies. even though their share prices have risen a lot. So momentum still looks okay if you look at the capital markets day they had and the targets they still have. Sanlam, very interesting, has done a lot of deals. And if they get everything in place and India keeps on performing for them, then Sanlam also looks interesting. So I think Old Mutual's got a lot of work to do to catch up to its competitors.
Okay. And actually, just one more. Okay, so because there was a question that should I sell my Old Mutual for Momentum or Sanlam? So JP, I don't know. Would you?
I would. If it was me,
okay.
If I were in those shoes, I would.
You spoke about Momentum, Grant. Would you switch your Old Mutual for Momentum?
Look, at the current levels, it's a little more challenging, but we have been involved in Sanlam and Momentum for a number of years now.
Okay.
And I think they are the better executors and operators and quality at this point. So you're kind of selling at the low and buying at the high, but that's assuming they turn the ship around. If they don't turn the ship around, it's definitely the right, you definitely want to just get into the quality of Sanlam. So I'm sitting on the fence because I'm not sure about the timing.
Yeah.
But I will say, I think if you're taking a 5-year view, I know that's long, I would stick with the highest quality and I would stick with the Sanlam.
There's a question here, PSG Financial Services versus Signia. Yeah, if in that financial services space, you were to look at these two, I guess which one would be in favor with you, JP?
That's an interesting one. So I think firstly, Signia obviously has a controlling shareholder, and that complicates matters. There's a few related party transactions that I don't like.
Okay.
But the business itself has been performing very well, and they've taken a base of very low margin assets under administration and used that to build a very good exchange traded fund business, as well as a retail business with actually some reasonably performing funds that charge reasonably high fees. So they've got this mix between low fee ETFs and higher fee active funds. And on that assets under administration base, the business has done very, very well. So we do own some Signia, and we like the business, notwithstanding some concerns regarding the shareholder arrangements. On PSG, Financial Services, we like that business as well. So similarly, it came from a relatively low margin business. The wealth business has done very well to protect their turf. The asset management business has built a very nice business under Annette Ahern over the last decade or so. And the insurance business is generating very good returns. So I like that business as well. So if you have space in your portfolio, I would say consider both.
Okay. All right. Grant, your view on both those companies?
I like both of them. I've liked them for a number of years as well. And I think everything JP said is spot on. And I guess at a push, if I had to own one, I would go for PSG because I like the entrepreneurial model that I think is a big growth driver in that business. But they're both really good little businesses. I 100% agree.
All right. Cap Industrial came out with an update today. And the question goes, your view on Cap's latest update. Where do you see this company going? Will the share bounce back? 10 years ago, it was around 10 Rand. Today, it plunged more than 22% on that 11-month trading update. JP, I don't know, if it's plunging 22% at this point, what is it? I think about 2 Rand. Could it go back to 10 Rand?
Sure. Zanati, for that to happen, the operating performance must improve substantially. And I don't really see that happening. They mentioned that so far they're tracking behind their debt reduction. So far, things aren't looking that great in terms of the different businesses. The silver lining is they said they've now spent just about all the capex they wanted to, except for Unitrans. There's some fleet renewal that needs to happen there. So the good news is, hopefully from this point forward, the operational cash flows won't go into capex, it'll go into debt reduction, which is quite important for them. The CEO, after many years, has resigned from the business, which is an additional concern. At least the CFO is stepping up and will become the CEO, so there's some continuity there. But the business, in my mind, it's a collection of businesses that don't have particularly strong competitive positions and particular pricing power. And therefore, the returns on capital are average. And if your returns on capital are average, your share price performance is normally average to below average. So that is what we've seen. I don't expect the businesses to miraculously become above average and generate very strong returns on capital. So unfortunately, I'm also not too optimistic about the share price. It could rebound from the very low levels because of the fear in the market regarding the debt levels. But to go back to 10 Rand, I don't see that in my crystal ball.
And it's quite interesting that at the beginning of the show, we were talking about economic growth and how these shares on the JSE have performed. But it seems that, I mean, with an industrial company, I guess the industrial sector is also one that you can expect to actually track economic growth. So I wouldn't expect them to outperform. But at the same time, if I remember correctly, this is the same company that went outside and got businesses outside of South Africa to kind of hedge their risk against the South African economy. What do you make of how it's done and how it hasn't really performed as everyone expected? Grant?
So to be honest, I'm not that close to this one anymore. It has been disappointing, but most small and mid industrials have battled, there's no growth. The pie's not growing. And the big boys like the Bidvest of the world have the balance sheet and the ability to grow, with cost savings and just win deals with balance sheet, etc. So I think they're in a tough space. This company will do well if we ever achieve that holy grail of economic growth. These little companies will do tremendously well, but it does seem a long way off. So I don't have any more insight than that.
Yeah. All right. Well, let's get into coal. Exxaro and Thungela are dark polls. When polls are dark, days are few. Which is more trustworthy given the darkest days in the dark commodity price? It's very, very, very dark commentary there, but sure. In these dark times, commodity times and coal prices, Exxaro and Thungela, which would you go for, JP?
Well, Exxaro announced this huge manganese deal, so they are spending a lot of money to go into manganese. That makes me a bit nervous. Obviously, Thungela also spent quite a bit of money to buy at least another coal mine, but one in Australia, of all places. I don't know necessarily if that was the best decision to do with their capital. So it probably depends on your outlook for the commodities. If you think coal will do well, then I would stick with Thungela, the pure play coal play. And if you think a combination of coal, iron ore, and manganese could do better, then you could look at Exxaro. I'm not particularly optimistic about either, but then generally I'm not very optimistic about mining shares at most times. Every now and then they have their day in the sun or 2 years in the sun, and they give you wildly positive returns, and then they track back to the long-term average. We saw that in the platinum space. There's some fever that maybe you'll get another little blip upwards quite soon from the previous one that was only 2-3 years ago. You're seeing it currently in the gold space, a lot of excitement in gold. And you saw it in coal when there was excitement when Russia invaded Ukraine. So unless we get some other excitement in the coal space or iron ore or manganese, I'm not very optimistic about these share prices of Exxaro and Thungela.
Well, as we're talking about those commodity counters, let's veer off into iron ore. Somebody's asking about Kumba. I guess the previous question really depends on your taste, whether you like coal, whether you like a diverse counter. So this question is quite interesting. Is this a buy with the high tariffs on steel? I'm just wondering how the steel price or the steel tariffs could affect then iron ore production and sales. Grant?
Look, I think the steel tariffs can have an effect on the demand into China, but already the iron ore price has been depressed. It hasn't gone anywhere, and it's been burdened by the Chinese property sector and the lack of infrastructure rollout in China as well. So iron ore it's in a challenging place. And of course, we have Transnet issues as well. So Kumba can't even sell all the all the iron ore they can dig out of the ground. So there's sort of a double challenge there. But it does operate a high quality mine, very strong cash generator. And iron ore's lagged a lot of other commodities this year, for obvious reasons. But I think if you think that commodities continue to improve, the likes of copper, cobalt, PGMs, everything's had a much better year than iron ore. And there's probably some reasonable value there, I would say, in Kumba. And so while I think the tariffs may have a short-term effect, long-term, the total demand for iron ore globally will remain the same. It's just where the demand, who sucks up the demand and where it's consumed.
All right. Well, where are you gents seeing value today? Your stock picks, JP.
I'm picking a US listed stock in the buy now, pay later sector. There's quite a few plays in the sector in the US. There's Affirm, there's Klarna, there's Afterpay, but I'm choosing Sezzle. It's a bit smaller than their competitors, but if you look at all the reviews of the users of this buy now, pay later service, they get better reviews than most others.
Okay.
If you are very good with your finances, this is a beneficial product. You can buy something and they will effectively extend you some credit. And you can pay in 4 installments with no interest, and that's brilliant. But the moment you miss an installment, oh my goodness, the fees and the interest add up. And that is the whole model of buy now, pay later. So it's very good for people who are disciplined in their finances, and it is costly for people who are not disciplined. And Sezzle is a responsible player in this industry, I would say. They announced today that they are taking Shopify to the US courts for anti-competitive behavior. So hopefully that means that they can get their plugin into the Shopify app or ecosystem to work even better. So far, it hasn't really worked for them. But of all the buy now, pay later operators, I like Sezzle the most.
And I must say, I do like buy now, pay later. I'm a fan, especially for big purchases like furniture. It's better than what we had back in the day with lay buying. With this one,
yes.
With
you
this
can
one,
take that furniture with you.
Exactly. Oh, Grant, what is your stock pick for today?
My stock pick of the day is Workday. It's a software as a service company. They do cloud-based human capital management, so HR, payroll, financial management, etc. They compete with SAP, Oracle, playing in that space. But it's a quality operator, strong cash generator. And I really like these software companies that are entrenched in large customer bases, because I think if they use AI properly, from cost-saving point of view, from a data integration and analytics point of view, there's a genuine opportunity for growth and for operational leverage as well. So I think they are well positioned for that. And so my pick of the day is Workday.
All right. Well, thank you so much for your time and for your analysis today, gents. Really appreciate your time. That's all for tonight's Stock Watch. Thanks to our guest, Jean Pierre Verster from Protea Capital Management and Grant Nader from Benguela Global Fund Managers. Up next, The Close. Stay watching.